What is up, guys? Mike Hwang here. Today we're going to talk about the hedge fund manager who lost at least $10 billion last week. In this video, I'll uncover exactly what happened and how it happened and the lessons we can learn from this incident. So before we begin, make sure to smash the like button and subscribe for more videos. On Friday, there was an unprecedented amount of sell volume from a block trade initiated by Goldman Sachs. Now, for those of you who don't know, this is what a block trade is. So when institutions either sell or buy in bulk, their actions can affect the market. So what they end up doing is forming huge block orders that are traded over the counter so that it doesn't affect the price of the asset that they're trading. By definition, a trade of over 10,000 stocks and over $200,000 in bonds are considered block trades. So this is what happened. There was a $10.5 billion large block trade that occurred through Goldman Sachs. And this is an unprecedented size even for Wall Street veterans. What exactly happened? Turns out, Goldman is just the middleman who confirmed the transaction for the block trade. And the man behind the trade is a Korean hedge fund star named Bill Hwang. Bill was a hedge fund manager at Tiger Management, and he went out on his own to set up a company called Tiger Asia. He got in trouble for insider trading in 2012, so he set up a new company called Archegos Capital Management, which is a family office. For those of you who don't know, family offices manage the money of partners within the firm as opposed to normal hedge funds, which take money from external investors. So Bill Hwang's office focused on Chinese tech and US media and telecommunications companies. Basically, Bill was running a $5 billion fund with 5x leverage, and he tripled his money at one point, but simply didn't take profits. He held onto his positions for too long and didn't take profits when he should have, which caused him to get liquidated on his positions. This is why leverage is super scary and why you should be careful with it. A man who turned $15 million into $15 billion using leverage had his account completely wiped out because of leverage. And because he was a huge whale, this caused the price of stocks like Discovery and Tencent Music to drop. In case you don't know, here's a quick crash course on how leverage is used and why it's so dangerous. Imagine that Bill has $1,000. He decides to use leverage to buy Baidu stocks. So he gets a loan of $4,000 from the bank. He buys $5,000 worth of Baidu stocks, which moves up by 20%. So the value of his money invested is now $6,000. Now, if he returns the money to the bank, he's left with $2,000. He basically used $1,000 of his own equity to make an additional $1,000, which gives him 100% returns. So despite the stock moving only 20%, because he was using leverage, his return on his equity is 100%. But take the case where he gets the same amount of loan and buys the same stock, but the price of the stock drops. Let's say the value of the stock drops to $4,000. The bank is now scared that they might lose the money that they lend to Bill. So before Bill generates further losses on his Baidu stocks, the bank forcefully closes his position in order to prevent further losses. When the bank does this, it's called liquidating a position. So the bank takes the $4,000 that they lent Bill, and Bill is left with $0 because he lost $1,000 from the position. This is what's scary about leverage, getting your position liquidated. If you held $5,000 worth of Baidu stocks without any leverage, the value of the stocks could drop to $4,000, but they could ultimately go up again, putting your position at, let's say, $8,000. Because the number of shares you hold does not change if you're using leverage. You'll have the same number of shares regardless of the price fluctuation. But if you're using leverage, the price could drop initially, liquidating your position, only to go back up as you initially anticipated. When that happens, you're left with nothing, literally zero, nada. So even if the price of the stock bounces back up, you're liquidated and you're done. So how exactly did Bill Hwang set his positions, and exactly how much did he lose? According to reports, it's said that one part of Hwang's report, which has been traded in blocks since Friday by Goldman, Morgan Stanley, Wells Fargo, was almost worth $40 billion last week. But as disposals keep emerging, estimates of his firm's total positions keep climbing, and there's even an estimate that the total position could be well over $100 billion. So for now, nothing concrete has been disclosed, so we don't know how much the firm has lost yet, but that should be revealed soon. Here's how Hwang did it. He used financial tools called CFDs and swaps. These are pretty complex topics, so I'll explain what happened in layman's terms. So instead of investing his money directly in Baidu stocks, Bill did it through Goldman Sachs. And because I don't know the exact terms of the contract between Bill and Goldman, I'll just explain it as easily as I can without the details. So Bill makes a sort of bet with Goldman Sachs. He says, yo, if Baidu's stock price goes up by X% until date Y, you pay me. If it goes down, I'll pay you instead. So Bill doesn't directly hold the stocks, but he has a contract between himself and Goldman is the entity holding Baidu stocks. The problem with Bill is that he was using the prime brokerage service of other banks like Morgan Stanley, Credit Suisse, Deutsche Bank, and Nomura. So Bill had a contract with Goldman stating that he'd get paid if the stock price of Baidu goes up a certain percent, and that he pays if it goes down a certain percent. But he had the same contracts with different investment banks and for different stocks as well. So when he holds positions in these Chinese tech stocks and American telecom and media stocks, it doesn't appear on the firm's 13F because he doesn't directly hold these stocks. The investment banks that have him as a client are the ones who actually hold the stocks. So if we look at this is a list of the stocks that Bill Hwang was supposedly trading, and in the case of GSX, we can see that the investment banks have been holding close to 70% of the stock. Of course, not all of this is part of Bill's position, but it does go to show how influential he was as a client to these investment banks. So when Bill's position became problematic, Credit Suisse suggested that the prime brokers all unload their positions slowly and one by one. But Goldman decided to play it dirty and dumped all their bags ASAP, and Morgan Stanley followed almost immediately. So what are the lessons to be learned here? First of all, keep an eye on Goldman Sachs. Goldman is almost always fast with their actions. They were the ones to minimize their losses during 2008, and they minimized their losses in this case as well by stabbing other investment banks in the back. Secondly, leverage is scary. A lot of people casually talk about 20x leverage, and maybe this is because they got so used to seeing the 125x leverage on cryptocurrency exchanges, but leverage is very, 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 very dangerous. Bill Hwang is a legendary trader who turned $15 million into $15 billion, and he still got wiped out. Be careful with leverage. Lastly, while the whole situation is chaotic, it could be perceived as an opportunity for others to pick up some cheap Chinese tech stocks. I personally wouldn't touch them, but for technical traders who are looking to make a swing trade on oversold stocks, this could be their chance. So that is it for today, guys. I hope this explanation was helpful. Let me know whether you enjoyed this video by smashing the like button. If you guys want to see more videos like these, don't forget to subscribe, and I'll see you guys in the next video.